Hello viewers, welcome to India Equity Investing. Today we are going to review the fourth quarter performance of Anup Engineering and update our financial model accordingly. We will start by reviewing the quarterly numbers, followed by the update provided by the management, the valuation strategy that it talked about, and then we'll look at the updated financial model and the current valuations of the company. The company reported better than expected numbers for the financial year ending 23. It was basically a beat on all the guidance estimates that we had. The company reported revenue of 411 odd crores, which was higher than our estimate of 382 crores, and also showed a 43% growth on an annual basis. The increase in the operating leverage due to higher revenue resulted in higher than anticipated EBITDA margin of around 20.1%. The company achieved PAT of 52 crores, again higher than our estimate, and ended the year with an order book of 530 crores. So this provides good visibility for the coming financial year. Please note that our objective always will be to remain conservative in our estimates rather than being accurate. The management indicated that it had a good order book at the end of FY22, which allowed the company to achieve a strong revenue growth of 43% during FY23. Now the company, wanted to execute all its orders over the past 12 to 15 months that were booked at relatively lower margins because of escalation in the higher cost. Let us now talk about the Kheda plant. So this is a new manufacturing facility that the company has been setting up for last few years, and this facility is around 40 odd kilometers away from its current facility at Odhav in Ahmedabad. Now, the larger facility will allow Anup to address the entire inquiry basket of the client, which could not be addressed earlier. So, for example, Kheda plant will have lift capability of around 800 metric tons as compared to 500 metric tons at the current facility. So, what happens is that the company, earlier could not manufacture larger diameter vessels beyond a certain size due to capacity constraint at other facility. Now that can be done over here. Secondly, whenever the client gave them the orders, the company could only pick and choose some of the equipment that it could manufacture and not all of them. Now it will be able to meet the entire requirement of the client, and hence the revenue loss that was happening in this regard would not be taking place going forward. So overall for this plant, the company is, planning to spend around 250 odd crores across three phases. Now the phase one capex has already been completed over the last 2 to 3 years, and the first order dispatch is expected around August of this year. The revenue from this plant will start trickling in from the third quarter of FY24, and the full year revenues are expected to come in from phase one operations in FY25 and are expected to be around 150 odd crores. Since this is a new plant and it is coming up in phases, the asset turns at this stage are expected to be lower at around 1.25 times. But going forward, once the entire expansion has been completed across three phases, we expect the asset turn to be around 2 times. So I think that's how we'll look at it. The company will be spending another 80 odd crores in phase two over the next 2 years, and that phase again is expected to contribute around 150 crores to the additional revenue. Had COVID not taken place, the plant would have been set up till now, and it would have started, contributing significantly to the revenues. So that entire process has been delayed by a couple of years. I would now like to touch base on the point of value addition and the competitive advantage in this industry. So normally when we look at fabrication as a business, it does not have very strong competitive advantages in general. There are a lot of SMEs doing it. There's little differentiating one company from another, and you would look at it as kind of a conversion business with some margin attributable to it. But when you look at the company's financials and the kind of numbers that are reflected in the P&L and in the balance sheet, that shows a different story. So in order to understand that, we'd like to just delve a little deeper in terms of the competitive advantage that can exist in this business, specifically from the perspective of Anup Engineering. The company has always maintained that timely delivery of high quality materials has been its strong point. It is something that the customers really value. So let us evaluate the company on three key aspects. One is capability, second is capacity, and third is execution. Now, in terms of capability, the company, in order to maintain its competitive advantage going forward, is looking to move up the value chain. Then, in terms of capacity, the company is already setting up a greenfield plant, which is going to more than double its capacity to deliver. Now, execution is one thing that the company has always had in its favor, the ability to deliver in a timely manner. Now, in this industry, as in most others, you're as good as your last order execution. So the company will have to keep a tab on this. So if we look at it, the capacity is already coming up, the execution has already been there. We like to just touch base on the point of capability. Is that one area where the company believes that it can actually achieve a strong competitive advantage? Because the company believes that within capability, it's like to focus on high complexity products and use of exotic materials to differentiate itself from other players in the industry. So, when the company talks about higher complexity products, it basically refers to those heat exchangers and vessels that are manufactured using proprietary technology. Now, while the higher complexity products involve the payment of royalty, these products also ensure that the company has relatively lesser competition and can try to attain higher margins. Now, we believe that the company would be paying royalty fee anywhere ranging between 1.5 to 2% of the equipment cost. And the company currently is looking to manufacture equipment using licensed technology for urea and ammonia industries, so specialty chemical industries. The company currently has two key licensed technologies, and we are going to briefly talk about those. So the first one is helix changer heat exchanger, and second is embaffle heat exchangers. Now, helix changer heat exchanger is a proprietary technology of Lumis technology that the company is using currently to manufacture a number of heat exchangers and vessels. What this technology does is that it replaces conventional segmental baffle plates with quadrant shaped baffles within the heat exchanger. So what this results in is in creation of a uniform flow of matter. What this further results is in significant reduction in fouling, which is basically formation of unwanted material in the heat exchangers during the heat transfer process. So many times it has been observed that a fouling results in reduction in efficiency by anywhere between 20, 30 to even up to 50% in heat exchangers over a time after use of such heat exchangers, and this results in higher maintenance costs or requirement of greater fuel to attain the same desired temperature. What this technology does is that it allows the clients to achieve 2 to 3 times longer operational runs as compared to traditional heat exchangers with the greater throughput and at the same time with lesser requirement of fuel. Now, this licensed technology has been used by Anup for the past few years, and it is not an exclusive license. So, a number of players globally, worldwide, use this technology on payment of royalty. And for Anup specifically, it did contribute to a sizable chunk of heat exchanger revenue during last year, due to which there was an increase in the royalty payment as well. Similarly, there is another technology, the embaffle heat exchanger technology, that Anup Engineering has acquired from Prembana and Roll Group. on an annual royalty basis. Now, this technology again is basically, an innovative design in the heat exchanger that improves the performance and simultaneously reduces the operating costs of a heat exchanger, basically by reducing the fouling losses. So now the design here, allows for a longitudinal flow pattern based on the patented open structure baffle and engineering profile. So basically, it includes an expanded metal baffle, which translates it to M baffle as the technology that they have patented. Now, this again, provides specific flow characteristics that optimizes the heat transfer and reduces the tube vibration. Now, I think one of the key points to note here is that as compared to the previous technology, for this specific technology, Anup Engineering is the only fabricator in India that has exclusive license to use this technology for the India market. And this technology already exists in refineries and petrochemical plants across the world, and hence makes the case for easier adoption. So if we look at it, what these technologies basically do is that, they reduce the fouling, they, maintain better heat efficiency, and they reduce the overall maintenance cost of heat exchangers. Now, fouling, if we look at it, globally is a kind of a multi-billion dollar expense that is incurred by the petrochemical industry in the maintenance of heat exchangers and reducing the fouling costs. So any good plant that comes up typically prefers having heat exchangers built from such technologies because it reduces their O&M cost. So if we look at it from an ordinary fabricator's perspective, if they are going to bid for a specific project going forward, having access to these technologies certainly creates a strong competitive advantage and reduces the number of competitors that would eventually, be, well qualified to bid for such projects. The second point that the company talks about when it is referring to value addition is basically moving up the value chain. Now, what does moving up the value chain here imply? It basically implies increasing the thickness of vessel shells that the company is currently manufacturing and increasing the number of high value metals that is used in equipment manufacturing. For this purpose, the company has set up a clean room at Odhav, and that would allow the company to use exotic materials for a manufacture of equipment. So what the company is trying to do over here is that they just gave an example in this regard, that they currently use carbon steel in a vessel, and they would like to replace it with exotic metals like duplex steel or stainless steel. Now, if you look at the valuation that it does, it is quite high, because the price of stainless steel as compared to carbon steel could vary anywhere between, say, 1 to up to 4 times the price of the carbon steel. So even if you assume that the stainless steel being used by the company is valued at twice as compared to the price of carbon steel, so still what the company believes it will do is that it will get greater turnover for the same sales that the company is doing, and hence generate greater revenue per square foot of the operating space. So greater turnover, greater margins coming in, and not everyone can use exotic materials due to the complexity of the products involved as well. So this is another point where the company believes that it can get into value addition and hence create a niche for itself. Now we will review the financial performance of the company. And in case you would like to learn more about what the company does, you can also refer to our, initiating report of Anup Engineering that was published on 3rd of May this year. So for financial year ending 23, the company achieved a revenue of 411 odd crores with a gross profit margin of 46.1% and an EBITDA margin of 20 odd percent. Now this margin, as we have already discussed earlier, has taken a significant hit as compared to the last few years due to increase in the raw material prices for the fixed price contracts that the company executes. So going forward, there will be a margin expansion. The company was earlier indicating that it will get back to its earlier margins. The company was tentatively indicating a margin range of around 24%. But this time the company has taken that margin guidance down marginally and brought it in the range of a little over 22%. So that is what the company says. So overall, the company is indicating that they will grow between 25 to 30% over the next few years, and will endeavor to maintain an EBITDA margin of more than 22%. At our end, we have assumed that over the next 4 years, the company will grow at the rate of 22%, and will, see a marginal expansion in EBITDA margin from, 21.5% in 24 to a little under 22% in FY27. Now, my sense is this number may again get marginally revised downwards going forward, as the company tries to attain higher revenue trajectory. Let us see where it comes to as of now. We are currently in our model. We have assumed an exit at the end of FY26, when we believe the optimism will be high and the company's margins would, may be in the range of 21.5 to 22%. So, overall, if you look at it for next year, that is end of financial year 24, we're expecting the company to achieve a revenue of 514 odd crores with a 21.5% EBITDA margin and a 70 crore PAT at a PAT margin of around 13.7%. Now, one key point to note here is that the revenue estimate taken by us for FY24 is lower than the order book that the company had at the end of this financial year. So if we look at it for FY23, the company achieved a revenue of 411 crores, while at the beginning of the year they had an order book of around 390 odd crores. So currently they have an order book of around 530 odd crores, and we are assuming it will end the year with a revenue of around 514 odd crores. Now here we see the split of the key costs that the company incurs. So if we look at it, we are assuming a gross profit margin of around 47.5%, and then another 5% is the cost incurred towards employee expense, and then there is around 21% cost incurred on other expenses. Now we have tried to split it out for the past few years and see what this number basically includes. It includes half of that goes towards job work and contract labor charges. So basically the third party employee expense incurred by the company for the contractual labor that they engage. Then there is some cost incurred towards freight insurance, and there is around 1% of cost that is incurred towards royalty. Now this royalty is basically for the heat exchangers, and if we look at it, this number, if we try and back calculate it based on the revenue contribution that the heat exchangers gave in FY22, the number comes to around 1.5 to 2% of the heat exchanger revenue. So then coming forward, when we look at it, the return on equity for the company, we believe it will get closer to 15 plus percent in FY24, and overall return on capital employed also remains very healthy for the company. So cash generation is going to continue for the company going forward as well. Now, looking at the balance sheet of the company, we see that the total asset base of the company is increasing from 740 odd crores in FY24 to around 161 odd crores in FY27. So this 400 odd crore increase in the asset base is basically coming in the form of increase in current assets that we see. And this increase that we have shown, is basically coming in the form of higher sundry debtors and inventories, which we have kept largely consistent in terms of the inventory as percentage of sales or debtor days. Going forward, the company has been able to maintain a good control on receivables, and we believe there is no reason to believe the company will not be able to do so going forward as well. So, these two are taking up the increase in the asset base, and then there is a marginal increase in cash also. So, we have been largely conservative over here. We have assumed the phase two and phase three capital spent for the company. So, over the next 4 years, we believe the company will spend and be close to 120 odd crores more in the capital expansion, 130 odd crores. And after that, we have not envisaged any further capital expansion by the company. And this overall, we believe, would allow the company to attain a turnover of around 900 to 1000 odd crores. Here we take a closer look at the ratios for the balance sheet of the company. So overall, we have assumed that the net working capital days remain largely flat. We have increased them marginally to around 127 odd days from 123 days of today. After that, we have assumed an asset turnover to increase the GFA turns to increase from 1.4x as of today to closer to 2x in FY27. But please note, we are assuming our exit at the end of FY26. Now, looking at the cash flow statement of the company, we believe the company will generate a cash of around 300 odd crores from operations over the next 4 years. And during this time, the company will spend close to 135 to 140 odd crores in the capital expenditure. So we expect the company to generate good cash from operations going forward, despite the fact that it is growing very rapidly and is also reinvesting capital for a future growth. So now looking at the current valuations, as of 19th May 23, the company is trading at close to 27 times its FY23 earnings. And so this number is higher than our outgoing year estimate of exit multiple of around 20 to 25 times. So if we look at the valuations as of today, the company has a market cap of around 1400 odd crores, and in the exit year, which we have assumed as March 26, we are assuming an exit multiple of around 22 to 24 times. On that basis, with a 3 year horizon, the company is likely to generate an IRR of anywhere between 19 to 23% based on current prices. So, again, I believe that, our multiples as of now are, fair, I would say, maybe marginally optimistic, but fair. There is a possibility of these multiples getting overshot as well. We have seen such companies trade even up to, 30 time plus as well. So, assuming a fair multiple of around 20 to 24 times with the revenue growth and profit margins that the company has, we believe this kind of number is achievable. And maybe the company has, overshot in terms of pricing in the near term. But if it corrects, it can provide an interesting opportunity for investment based on the kind of expectations that an investor may have. So here we look at the trailing 12-month, PE multiple chart of the company as of today. So we see that the company is trading at, historically high multiples. And if you, look at my philosophy, I would never, place an investment bet at historically high multiples. I would always wait for such multiples to correct so that I can benefit not only from earnings expansion, but as well multiples expansion. From the current point in time, if we invest in the company, we are unlikely to benefit, or let me rephrase it, the probability of benefiting from multiple expansion is significantly lower, and we would only benefit from earnings expansion. So rather than having one engine of growth, it's always better to have multiple engines. But I think in long term, we can expect the company to trade anywhere in this range, 22 to 24 times. And if it falls and comes closer to 20 odd times its trailing earnings, then it would present a even better investment opportunity from where it is as of today. So I hope you found this presentation to be informative as well. And we would strive to share more such interesting videos with you going forward as well. So thank you so much once again for your time.